Hi, I'm Andy Gomes with Guaranteed Rate, and today I'm going to talk about why rates are poised to move higher. So in the last year plus, we had an economic event called COVID, and the feds, in order to kind of keep the economy from falling off the cliff and into the abyss, took extreme measures. They took the same measures that they enacted back in 2008 during the financial crisis, but they just put those measures on steroids. And what did they do? They lowered the Fed funds rate down to zero, which means that the rate at which banks borrow money from the feds, and they started buying bonds like crazy. They started buying treasury bonds, they started buying mortgage-backed securities, they started helping the repo markets, which is kind of a very complicated overnight market where like banks and creditors borrow short-term money for gap coverages, but they financed that as well, and they just brought down interest rates to extremely low levels. And now the economy is starting to heal. We're starting to see the price of goods go up. Gas is higher. Most groceries have gone up in price. Like everything's starting to increase, and part of it is the supply chains with the disruption with COVID and all the supply chains, and part of it is just kind of organic inflation that we haven't really seen in our economy in quite some time. But what does this create? Like, what are the feds thinking right now? They're starting to get political pressures because the cost of living is increasing due to inflation, and the feds are supposed to be independent from political pressures, and it's getting harder and harder for them to do that. We have politicians who can just go on any TV network and voice their opinion. They can Twitter, they can go on social media. The feds have consumers who can reach out to them easier than ever before with their concerns. So it's harder and harder for the feds to stay kind of disconnected from some of the political and economic pressures to make decisions, right? So they're going to start seeing this inflation, and they're going to start getting concerned about it. What do the feds do when they see the price of everything going higher? They could do one thing, right? Raise interest rates. That solves it, right? If everything gets more expensive to finance, the consumer then has less gunpowder, right? They have less ability to obtain cheap money to then go and buy like new cars, new homes. Their interest rates on their credit cards go up. So everything gets more expensive for the consumer when the feds increase rates, which creates less consumer demand, which then kind of helps bring down inflation overall, because then business activity and everything slows down. So businesses then have to lower prices to entice buyers to purchase their goods or services. So that's kind of like the sequence of events that occurs. And this time around, the feds, what they're going to start doing first is withdraw the support of the purchase program for mortgage-backed securities, which has been keeping rates super low. Rates will not be this low if it wasn't for extreme intervention by the feds. So we're likely going to see rates increase over time. I think the 30-year fix, which was as low as like 2.625 only a few months ago, currently is sitting around 3.125, could go as high as 3.75, which was right around pre-COVID levels before they find the ceiling, right? So we're likely going to see rates gradually increase before kind of the bond participants see the current bond prices as such a value proposition that they'll start purchasing bonds and helping pushing prices back down on yields, which will help bring rates back down. But that could take a while. Bond markets don't fluctuate as quickly as stocks or other types of markets. The bond market is massive. It's so much bigger than the stock market. It's insane. It takes a lot longer for rates to kind of come down after they spiked up. So we'll probably see rates gradually increase over the next maybe 6 months to a year before they start coming back down. And again, things could happen. Inflation can run much hotter than we believe, and rates could go higher than most people expect. Or, inflation could actually really impact the consumer's mindset, and the consumer will stop spending, which will kind of correct itself, and we may see ourselves in an economic slowdown, which will create the feds to reintroduce their purchase program of bonds, and we can see rates kind of do okay going forward, right? I don't have that level of a crystal ball. I kind of understand what creates the movements and the driving forces, but nobody has a crystal ball that's going to tell you for certain where rates or anything is going to be in the future. We just have our educated guesses, and my educated guess right now is we'll see rates gradually increase on a 30-year fixed up until about 3.75, and that's where I think we're going to kind of level off. And that's why I think, in my opinion, if you've been on the sidelines looking to refinance or purchase a home, like, now's a really good time to do it before the cost of capital increases, which makes the home acquisition price much more expensive. So if you are looking to get qualified for a home loan, my team and I are awesome at it. Just leave a comment below or give us a call. Thanks so much.